Good morning, ladies and gentlemen, and welcome to the Epoch Investment Partners webinar. I hope you're all well. My name's Stephen Fletcher, and I'd like to thank you all very much for taking the time to join us this morning. Now, many of you on the call have been supporting the Epoch Fund as part of your income models going all the way back to when the fund was launched in 2008. Others on the call have been supporters of the funds in more recent years. On behalf of Epoch and the team at GSFM, I would just like to thank you all very much for your ongoing support. It's very much appreciated. So for those of you who are new to shareholder yield, the Epoch Global Equity Shareholder Yield strategy is all about cash. In Epoch's view, cash is king in the equity market, and shareholder yield is all about owning companies that return large amounts of cash to shareholders in the form of dividends, share buybacks, and debt reduction. A portfolio manager of this strategy is John Tobin, who is joining us from New York, where today it's, I think, John, 5:30 p.m. So first of all, welcome.
Thank you, Steve. Good to be here.
It's great to have you on the call once again. Prior to COVID, John was a regular visitor to Australia. However, for those of you who are yet to meet John, John is a managing director, portfolio manager, and also a senior research analyst on Epoch's Global Equity Shareholder Yield investment strategy. Now, just a brief introduction for John. Prior to joining Epoch in 2012, John was an economics lecturer at Fordham University, where he also earned his PhD in economics. Before that, he worked at HSBC Global Asset Management. And then prior to that, he worked 20 years at Credit Suisse Asset Management, where he was a senior research analyst with the US high yield bond team. And John is also a CFA. So moving along to today's presentation, this morning's session will run for approximately 20 to 25 minutes, and we'll then take your questions afterwards, which you can enter at any time in the Q&A box at the bottom of your screen. Now, the presentation today is titled Shareholder Yield, Reflation, Duration and Salvation. And with the US Fed on a mission to now bring inflation under control, John will address the normalisation of interest rates, the impact this will have on high yield and shorter duration stocks relative to other stocks in the market. And then finally, John will discuss Epoch's approach to navigating the path forward for investors. So John, with that, if it's okay, I'll hand over to you. Thanks very much.
Thank you, Steve, and thanks everyone for joining us this morning. I do have a presentation. I'm going to attempt to move through the slides here. It'll take maybe 20, 25 minutes, and then hopefully with, as Steve said, some time to take your questions. The title of this presentation, Reflation, Duration, and Salvation. I'm going to go through each of those topics in turn, and you'll see why we came up with those catchy names for each of these components. It's an updated version of something that we did in December. So these are some ideas that have been percolating at Epoch for a little bit, and really we think they're relevant for the things that investors should be thinking about in the current environment. So with that, let's talk about reflation. The view that we have at Epoch is that interest rates have hit an inflection point, and from here they are likely to go up. The reasons are pretty straightforward. We see above trend economic growth around the world. Just before getting on this webinar, I took a look to see what the Bloomberg consensus figures are. So for world GDP growth for 2022 and 2023, the consensus growth figures are 4.3% for 2022, 3.6% for 2023, and for the US, the consensus figures 2022 is 3.7%, and then 2023 2.5%. So I wanted to run those numbers by you. As Steve said, I am trained as an economist, so I think and look at the world through that lens. Those are above trend growth figures. If the world is going to grow by over 4% this year, and the US economy by almost 4%, that's considerably above the long-term trend growth for both the global economy and for the US economy. Even as we see growth slowing, keep in mind, this is above trend growth that we're experiencing. Now, the other part of our foundation for our view about interest rates heading higher is it's about inflation. And inflation, of course, is turning out to be less transitory than we thought. Early on, as we recovered from the pandemic, the view was that supply chain issues and inventory issues would be resolved pretty quickly, and inflation would turn out to be transitory. And now the view is that's not quite so, we're not quite so optimistic. And plus, we're seeing wage pressures at the same time. So inflation is less transitory, and the central banks around the world are starting to look at inflation with a greater sense of urgency, and they are all adjusting policy accordingly. So we've seen the Bank of England raise interest rates twice. The Federal Reserve in the United States has given us guidance that they expect to start raising rates in March, with at least 3 interest rate increases in March. And the market, as you know, is contemplating 5, 6, or maybe even 7 rate increases in the US in 2022. The Bank of Canada has told us they're likely to start raising rates in March. The European Central Bank has recently become less dovish and is even talking about the possibility of raising rates sometime this year. So all around the world, we see central banks thinking about inflation with a greater sense of urgency and starting to adjust policy accordingly. And this picture that emerges is one where it's hard to escape the conclusion that interest rates are likely to be moving up from here. This is just a chart that shows the consumer price index in the United States year over year, and you can see that over in recent periods, it's clearly headed higher. Now, this chart that I'm showing you now is an indication of what's been going on in the bond market. And what I'm showing here is the 10-year US Treasury bond yield, as well as the German 10-year government bond yield. And right around September in 2020, you can see both of these starting to move higher. The US 10-year Treasury on top pretty clearly has been in an upward trend since last September. And what I would draw your attention to in the chart in the lower line is the fact that the German Treasury bond is now above 0 for the first time in over 2 years. So the bond market is responding, and we're seeing rates move up. So, okay, that seems to be the outlook. Interest rates are headed higher from here, but what does it mean? What does it mean for stocks? Now, we've spent a lot of time talking in our shop about this concept of duration. It is, of course, a concept that is most familiar to fixed income investors, maybe a little bit foreign for equity investors, but we really do think that the concept of duration is relevant for equity investors and offers valuable insights in an environment where interest rates are likely to go higher. So let me just describe briefly how this concept of duration applies to stocks. It applies, honestly, it applies to any asset. It's all about understanding when cash flows occur. Are they occurring in the near future, in the distant future, and recognizing that money has a time value, and the value of $1 to be received 10 years from now is not the same as about the value of $1 to be received today or next year. And so when you think about stocks, especially when you think about growth stocks, stocks where the trajectory of revenues and earnings and cash flows is one where they may not be generating much in the way of cash flow or free cash flow currently, but the expectation is that as they grow, they'll see a ramp up in those financial metrics, revenues, earnings, and cash flow in out years as we look out into the future. However, there are lots of companies and therefore lots of equities where you can say these are companies that have been generating cash flow, growing cash flow, are generating cash flow today, and are actually paying attractive growing dividends today. So the general conclusion is these are shorter duration equities as opposed to some of those growthier stocks, which are long duration equities. Well, bond investors know in a rising interest rate environment, the thing to do is to shorten duration. And our argument is, as we've discussed this in our shop at Epoch, equity investors need to be thinking along similar lines, and they need to be thinking about the risk in their portfolios from holding long duration equities in a rising rate environment, especially long duration equities that have experienced significant price appreciation and multiple expansion in the past year or two. I'll share with you this next chart. It's very busy, I apologize. It actually is from an article that we saw recently. It was published in the Journal of Accounting Research, actually published in January of 2021. The study that was done here was an examination of the stock market performance during the drawdown that occurred in the spring of 2020 when the pandemic first hit. And what these researchers found is, as they looked at stock performance according to duration, it was the shorter duration stocks that were hit the hardest in the immediate drawdown. This is, and why would you say, why is that? And the explanation that they offered in their study was, this was, at least at first, perceived and expected to be a short-term disruption, and therefore most impactful on near-term cash flows, rather than cash flows 7, 8, 9 years from now. And so it had the biggest impact on short duration equities. So that's a picture, thinking about duration, thinking about long and short duration equities, that describes what happened in the immediate aftermath of the pandemic. Here's another perspective on it, if you will. The chart on the left looks at annualized returns for stocks in the MSCI World Index for the past 25 years. So for a very long period of time, the pattern that was evident is the one that you see on the left-hand side of this slide. The highest average annual return was for stocks with growing dividends, followed by stocks with stable dividends, followed by stocks with zero dividends, and pulling up the rear with the lowest returns, dividend cutters. That was the pattern for 25 years. It makes a tremendous amount of sense, so we can all look at that and agree with that. That seems completely plausible and expected. On the right, this is the same data, but just for the past 2 years, from January 2020 through December 2021. In this period, by far, the best return was from stocks that paid no dividends at all. So this anomaly of the past couple of years is puzzling, perhaps until we start to think about things through this lens of duration, short duration, long duration. It really is just the flip side of the previous slide that I just showed you about the short duration stocks getting hit in the onset of the pandemic. What this is telling us is long duration equities were outperformers in a period of artificially low interest rates. This next slide that I'm going to show you, I kind of apologize for the math. I won't spend much time on this. You probably remember this, some maybe vaguely, some maybe fondly, and maybe you don't remember it fondly at all. It's the present value calculation. And it just says that the present value of a stream of cash flows is equal to the discounted present value of each of those future cash flows. And the math is straightforward. And our argument is long duration stocks are going to face stronger headwinds when rates rise. And it's about the math, and you can't get around it. The math is straightforward and irrefutable. It says that for a given increase in interest rates, the impact on present value is greater for cash flows in the distant future. And that's sort of foundational as we think about duration as a concept and the application that it has to equities in the current environment. So now we get to salvation. And I have to say, when we thought about the title for this webinar, when we first gave the first version of it in December, our thought was, well, let's not be overly dramatic here. Salvation, what are you getting at with salvation? And my answer is, and I honestly believe this is the word that came to mind when we think about how the market environment is changing and how those of us, if you will, who kept the faith might finally be rewarded. And what I mean by that is those of us who continued to believe that the way we were investing in companies that have a history of growing cash flow, investing in companies that have demonstrated the behavior around sound capital allocation practices and policies, that should be a good way to invest. It was not the most popular way to invest in 2020, and it's been out of favor. And so the salvation part of our argument is the market environment is changing. The environment that we see for the next couple of years is going to be different than the market environment that we had for the past couple of years. And as I said, it's about this changing interest rate environment. So on the topic of salvation, let me share with you a couple of slides. This is from a study that was done by Bank of America. I actually have a few slides from this same study. We looked through it and we thought, this is really good stuff, and it's in line with what we're thinking, and we'd like to use it. So this first slide just looks at the behavior of high dividend yield stocks in different interest rate environments. And the evidence is that the high dividend yield factor actually has higher average relative performance in periods when the 3-month Treasury bill yield is rising than when it is falling. Perhaps for many that's surprising and counterintuitive. We tend to think, gee, dividend stocks are probably going to get hurt by rising rates. The evidence suggests the opposite. We also wanted to take a look at PE multiples. And we don't spend a whole lot of time on the shareholder yield team thinking about valuation in those terms, but nevertheless, we'd like to share this with you. What we're showing here on the bottom of this chart is the 10-year US Treasury. And we had a period of time, of course, in early 2021, when the 10-year Treasury moved up pretty significantly, pretty rapidly. It was the enthusiasm for the rollout of the vaccines and the reflation trade. And so the 10-year US Treasury quickly moved up to about 3%. And on the top of this chart, we're looking at PE multiples for the MSCI World Index on the top, the Global Equity Shareholder Yield Strategy in the middle, that's the brown line, and the MSCI World High Dividend Index, and that's the darker blue line. The area that we've circled, we're just trying to highlight how the PE multiple impact was significantly larger for the MSCI World Index than it was for either the shareholder yield strategy or the MSCI World High Dividend Yield Strategy. The thinking there is both the shareholder yield strategy and the high dividend index are representing shorter duration equities, companies generating cash flow, companies paying dividends, as opposed to the broader market where the impact of the increase in the benchmark interest rate was more pronounced on the PE multiples. I've got a couple of other charts that I'll go through pretty quickly for you. Oops, there we go. What we're trying to show here is, again, the idea that yield is an advantage when rates are going up and a disadvantage when they're going down. We're looking on this chart at the all-cap core universe. So there's strategies that fall into investments, all-cap core universe. We're looking at their returns in the first quarter of 2021 during an episode, as I just said, when interest rates moved up pretty significantly. And you can see the distribution of all the dots. Current dividend yield is on the horizontal axis and the return is on the vertical axis. And there's an upward slope to that line. If you fit a line through it, and the brownish dot there is the shareholder yield strategy. So with the 10-year Treasury moving up, there's a little box in the upper right where you can see the path of the 10-year US Treasury. In that environment, having exposure to yield was an advantage. Now, of course, as we all know, in 2021, we also followed that period with a period of lower interest rates. The interest rates started to come down. There were concerns and questions about the pace of economic activity. This was the period of time when we started to have the Delta variant emerge. So that was a period when interest rates were moving lower. And now the line that we fit through there has a downward slope to it, and Epic's return with its yield is at the lower end of this grouping. So just a proof point, if you will, another piece of evidence to suggest that yield is a tailwind when rates are going up and a headwind when they fall. This next slide is the same thing, but with a slightly different universe to compare against. Here we're looking at the global dividend focused universe, but it's the same point. Upward sloping line on the left as rates go up, downward sloping line on the right as rates go down. And the point is the same, that yield is a tailwind when rates are going up. Here's a slide that I wanted to share with you. This is something that we've spent a lot of time in the past year or two focusing on. More and more people are, to state the obvious, focusing on factors and factor analysis. And one of the factors that are present in your portfolio strategy. And we've done a lot of work using the style analytics software and database. And what we see when we look at shareholder yield is a consistent set of characteristics, consistent attributes, a value tilt. So in this chart, if you look at the blue bars on the left, those are the value factors: earnings yield, cash flow yield. The yellow dot, the little yellow square, that's the global equity shareholder yield strategy. That's where we fit in this universe. This is the Morningstar universe of large blend strategies. And we are at the top of the distribution in terms of value. The dividend yield characteristic is very prominent with shareholder yield. Again, you can see that we're floating above the box in terms of where we are relative to the other strategies in this category. It also has a quality tilt. Those are the purple boxes. And you can see median and above median characteristics or tilts for global equity shareholder yield on those two measures of quality: return on equity and net profit margin. And finally, lower volatility. In the distribution around market beta, we're in the bottom quartile. So value, high yield, quality, low volatility. Those are the consistent characteristics in the 16-year history of the shareholder yield strategy. Again, this is another chart, same thing, slightly different comparison. Now we're looking at the large value category. The characteristics are the same. One of the people in our shop who does this work and is the expert on it and has been educating all of us on how to think about factors in our portfolios and factor characteristics. He's described this, the way he described it, he said, these are the fingerprints of shareholder yield. He said, I don't care how I do this, no matter how many different ways I do this, no matter how I define the universe that I compare shareholder yield to, this is what I see emerging again and again and again. So these are our consistent attributes. One of the other characteristics that it's important to recognize, we do have the historical record, if you will, of generating a very attractive income, a very attractive dividend yield, but it's generated from a high quality portfolio. Sometimes when we're asked, well, what do you mean by a high quality portfolio? A couple of different ways we can answer that question. One way that I've thought about it often is, as a portfolio manager, when you ask me, are these quality companies? I say, yes. Well, what do you mean? They've got a history of generating cash flow that grows over time. They have a history of allocating capital appropriately, which means paying their shareholders an attractive growing dividend and demonstrating the ability to invest to earn a return above their cost of capital. To me, that's what I mean when I say this is a portfolio of high quality companies. We can also describe it in terms of the factors, as we just saw with those two charts from Style Analytics. Portfolio quality factors are consistently evident in the shareholder yield strategy, return on equity and net profit margin. And finally, it turns out, as we look at the portfolio of stocks that we own, almost all the companies that we own, almost all of them, have publicly rated debt. So we looked at the debt ratings for the companies that we own in the portfolio, and about 95% of them are investment grade. So we're generating an attractive dividend yield, and we're generating that dividend yield from a diversified portfolio of high quality equities. And the equities, these companies have investment grade debt ratings. So very strong, very high quality companies that are generating these dividends. Steve, please, if I'm running out of time, let me know, but I do have a couple more slides that I wanted to share. But don't hesitate to cut me off if you want to save time for Q&A and I'm running over.
Oh, that's fine, John. Keep going.
Okay, good. So this slide, we've borrowed some of the slides that we saw in this Bank of America research study. The point we're trying to make here is, as we look at the interest rate trajectory going forward around the global economy, it suggests to us that the PE expansion surge that's been driving equities is likely over. The folks at Bank of America, their quant group, their strategy group, has a long-term valuation model. And the chart on the left shows the projected returns for the next decade for this valuation model. And way off to the right, where it says current and there's a little red arrow, what their model is suggesting is that the next 10-year period will be one where price return is likely to be slightly negative. They also point out in this study, and you can see this in the pie chart on the right, over a long period of time, dividends have contributed about 40% of the total return historically for equity investors, as opposed to price return. And they're suggesting that over the next 10-year period, dividends could be even more important as a driver of return for equity investors. This is relevant, of course, for the outlook for equity investors going forward, but for us at Epoch, when we saw that, we said, well, that looks awfully familiar to us. If you've spent any time with, if you spend any time with Epoch over the years, I'm sure you've seen this chart. We've used this from the beginning. For those of you that know Bill Priest, this was in the book that Bill Priest wrote about cash flow and shareholder yield way back in the beginning. But it says the same thing, which is to say the long-term drivers of equity returns are dividends and earnings. PE multiples expand and contract, but over time, that effect tends to wash out. And what you're left with as the long-term drivers of returns are earnings, which are almost always positive, and dividends, which are in fact always positive. So that really resonated with us, that Bank of America study, with what we've studied and shown and said over the years as we've talked about shareholder yield. This next slide is one that we've put together fairly recently. We've been working on this over the past couple of years. Here's a strategy, global equity shareholder yield, where we say we're looking for companies that pay dividends, that use excess cash flow to buy back stock and or pay down debt. And we're looking for companies that have cash flow growth. And so we were challenged to come up with a way to show that we do what we say we do, that we have in fact invested that way. So over this long term, and this goes back to 2009, year by year by year, it was challenging, I have to say, and we had to make some simplifying assumptions, but we've been able to say with some conviction that this is what the returns look like. The contribution of dividends, cash flow growth, share buybacks, and debt reduction, year by year by year over time. What we're showing in this chart, as you look at across the bottom, is the components of shareholder yield, so dividends, share buybacks, debt reduction, and cash flow growth added together. And then below that, the total return in the year for the global equity shareholder yield strategy in US dollars. And as you look across from left to right, you might say, I don't see much correspondence or correlation between any given year's return and that year's components of shareholder yield. But when you look at the very, very far right of this chart, when you look at the long-term average, the average contribution of these components is 10.7. And the average return of the global equity shareholder yield strategy is 10.4. So it may not be evident in any given year. In 2020, for example, you can see that the components added up to 5.7, and the return in US dollars for the shareholder yield strategy was minus 0.5%. But what you do see emerge over time is this close correspondence between both the components of shareholder yield and the return, the average return that the strategy generates over time. I think this is the last one that I borrowed from my friends at Bank of America. I probably should take them out to dinner and buy them drinks because I've used a bunch of their slides here. This one just shows the cash, the liquidity in the US corporate sector. And the point we're trying to make here is that we see significant opportunities to harvest shareholder yield. Companies are very liquid. They have a tremendous amount of cash. US companies have $7 trillion in corporate liquid assets, cash and short-term investments. So when we ask, will companies have the ability to continue to make attractive distributions, pay dividends, grow dividends, use excess cash to buy back stock and or pay down debt, this would suggest that they very much have the capacity to do that. So to summarize, reflation duration, and salvation. I won't go through all these bullet points in the interest of time, but this is the thesis that we're laying out as to what's happening in the environment now, and why should investors be thinking about a strategy like shareholder yield? What is it that shareholder yield offers, and what does the environment look like, and why might it suggest that a strategy focused on companies investing and appropriately generating cash flow, generating growing cash flow, paying attractive growing dividends, shorter duration versus longer duration, this should be a strategy that is successful in the environment that we see. And I guess a couple of slides to conclude, and then I'll turn it back to Steve for some Q&A. You know, this slide shows the number of companies in the portfolio that raised their dividends year by year by year. 2020, during the pandemic, there was a lot of concern that the environment had changed. The business environment was so challenging that companies would stop paying dividends, companies would stop buying back stock. We actually published a paper, and maybe you saw it. We did a webinar, and perhaps you saw that as well. The death of dividends greatly exaggerated. And so here we can now look back at 2020 and say, in 2020, 67 companies in our portfolio raised their dividends. So not only did companies not wholesale abandon shareholder distributions and good, sound capital allocation practices and policies, when we look at our portfolio, we made the argument that many companies would be able to continue to pay dividends, and many companies would even be able to continue to grow dividends. And the evidence is there. 67 companies in 2020 raised dividends in our portfolio. 2021, we see 85, on a par with 2019, 2018. So we did have a dip down, if you will, from 85 in 2019 to 67 in 2020. But here we are at the end of 2021, and we can look back at our portfolio and say, we had 85 companies in our portfolio raise their dividends in 2021. So we see that continuing. We see companies continuing to adhere to sound capital allocation practices and policies, or at least we're able to find companies that are doing that. It's a strategy that provides abundant, steady income, as I've said already, from a diversified portfolio of high quality companies generating attractive dividend yield. This is the dividend yield of the strategy from the beginning. It's been above 4%. It's currently a little bit below 4%, but it consistently over 16 years has provided an attractive dividend yield, attractive on an absolute level and attractive on a relative level. You can see for comparison purposes there, that's the Barclays Global Aggregate Bond Index. So the yield pickup over bonds from our portfolio is significant. And not to be forgotten, this is one of the most important characteristics of the strategy. We do believe investors should be mindful of the downside protection that the strategy offers. The history of the strategy over a long period of time is it outperforms, not all the time, but in down markets, when the market returns are negative, 72% of the time the portfolio outperforms the benchmark index by an average of 3.85%. And maybe even more importantly, in those environments when the market is down significantly, when the market is down more than 5%, in those kinds of environments, the strategy outperforms 82% of the time by an average of over 5%. This is real data from the real strategy, not back-tested data, not simulated data. This is looking at the 16-year history of shareholder yield as a live, actively managed portfolio. And that's the track record with respect to downside capture. I'll leave it on this slide. This is the long-term return slide, and I'll stop there and turn it back to Steve. So hopefully we have some questions that I can try to address.
Terrific. Well, thanks very much, John, for the presentation. There's some really interesting slides in that deck, and we'll be sure to get those slides out to everyone on the call today. We do have a couple of questions coming through, and I think just sort of following on from the downside protection slide, looking at equity market drawdowns that we have witnessed over the past, say, 15 years since the strategy's been running. The reasons for each of these drawdowns are different. yet shareholder yield stocks have weathered the storm better than the broader market in pretty much all of these periods. Can you remind us why this is the case?
Sure, Steve. And it makes a lot of sense if you stop to think about it. A number of times already, I've pointed to the fact that we seek to invest in companies that have certain characteristics, like a history and a track record of generating free cash flow that grows over time, and a history and a track record of paying an attractive dividend that grows over time. Businesses that can do that are inherently stable businesses. The business models are less volatile. It is, in many cases, it's because of they serve a wide variety of industries and a wide variety of geographies, and they can have parts of their business that are perhaps facing headwinds and other parts of their business that are facing tailwinds. And the net result is that they continue year after year after year to generate cash flow and to support and pay dividends to their shareholders. If you take a portfolio approach and you put a whole bunch of them together, now you've dampened even further the impact that market movements can have. So it does tend to have a dampening effect, just this portfolio diversification from these kinds of companies. So that's fundamentally the reason, I suppose, that this is a strategy that is more stable and more resilient and more durable in market downdrafts. I know that that's an important concept and an important issue. And honestly, I was expecting a question on downside protection. And what I found myself thinking about was, well, January, when we just lived through January. January was a period when the market was down and we significantly outperformed. And like I said, it doesn't happen. I can't tell you that every single month that the market's down, we're going to outperform. But it is a long-term characteristic. And when I look at the portfolio in January and I say, well, what was it that helped us outperform and have that downside protection in January? Well, a couple of sectors where we have exposure, kind of the obvious ones. We have exposure to energy. And of course, energy did well because oil prices were rising. So fair enough. Total Energy, Chevron, Enterprise, Pipeline Partners are stocks that we own that did quite well in January in the energy sector. And then the financials, you've got the interest rates, benchmark interest rates moving up. That's always seen as a tailwind for financials, for banks and insurance companies. They like higher rates, they like a steeper curve. So no surprise, I suppose, that some of the stocks we own there, like the big German insurance company Allianz, Royal Bank of Canada, MetLife, those are just three that I looked at when I looked at the portfolio that were noteworthy in terms of the strength of their positive performance in January. But maybe more importantly, I guess what I'd like to leave the listeners with is the fact that it's much broader than that. It really spans the whole portfolio. So as I looked across our portfolio and the performance in January as the market was down, our telecom names, most of our telecom names were up. We own a couple of European telecom names like Orange, Telenor. They were both up nicely in January. AT&T was up in January. I look at our staples holdings. Coca-Cola was up nicely. Healthcare, we have a fairly good exposure to healthcare and pharmaceutical companies. Bayer, Merck, these are both stocks that were up significantly in the month of January. Industrials, Lockheed Martin, BAE Systems, Raytheon Technologies, so the defense contractors, they all had strong positive performance in January when the market was down. Even in the material space, BASF is a stock that we own, the world's largest chemical company, and Dow, another very large global chemical company. Also, strong stock performance, positive stock performance in January. So as I look at our portfolio in January and say, gee, we provided good downside protection. What was working for us? There were a lot of stocks in a lot of sectors, in a lot of geographic regions that were helping to contribute to the performance of the portfolio during that downdraft in January. So long answer to your question, but hopefully helpful for the listeners.
Definitely, and some really good examples there. Another question for you. As I mentioned in your introduction, you worked previously at Credit Suisse as part of the high yield bond team. So you have an eclectic background, having worked in both debt and equity. So for this reason, you will probably know the definition of a bond proxy as good as anyone. But my question is, can you explain the impact of rising rates on so-called bond proxies within an equity portfolio?
Sure. Well, of course, I've talked a lot about duration and the evidence of how the yield factor can actually be helpful in a rising rate environment. But the bond proxy argument, it's one that's been around for a long time. Over the years, in any episode where interest rates start to go up, that was a question that we would ask. Clients would ask us, consultants would ask us, how will this strategy do in a rising rate environment? Because you're invested in all of these bond proxies. And that's when we would push back and say, look, I know what you're getting at. There's a tendency to think of certain kinds of companies as bond proxies. Telecom companies, staples, utilities. People think of them as bond proxies, but if you stop and think about them for a minute, I think you'll see that that's an overly broad characterization. If you showed me a company, Steve, and you said, here's a company that pays a dividend, the dividend hasn't changed in years. It's the same dividend this year as it was last year and the year before last and the year before that. So flat dividend. Every quarter, they pay the same dividend. I'd say that's a bond proxy because that looks a lot like the coupon that you get every 6 months from a bond. That's the kind of stock that will be affected negatively when rates go up. Just like a bond, the present value of that stream of dividends, just like a stream of coupons, will go down when the interest rate goes up. But what we've always said about the shareholder yield strategy is we're investing in companies with growing cash flow, paying attractive growing dividends. And so that means that feature, that factor, the fact that the dividends are growing means they're really not fairly characterized as bond proxies. So that I think is maybe the strongest argument that we can give, that because of the kinds of companies we're looking for, we're not investing in bond proxies. We're investing in companies with growing dividends over time.
Great, thank you for that. John, just following on from recent earnings season, we've all heard about the big misses from some of these mega cap tech stocks such as Facebook or Meta, Netflix, etc. Do you have any comments that you can make on company results within your shareholder yield portfolio?
Sure. I think I would say generally, the environment that we're describing with above trend economic growth is one that is helpful and healthy for businesses. So businesses generally are doing well. We're almost through the earnings season now. And I think the statistics are pretty clear that companies are generating good results. They're generating results that in many cases exceed consensus expectations. So the general view is companies are doing well. And indeed, when we talk about the return of dividend paying behavior, it's in response to an improvement and a recovery in the business environment. So revenues and earnings and cash flows have recovered, and that's what's allowing these businesses to start to resume paying and growing dividends. I can just give you a couple of examples, maybe off the top of my head. One that comes to mind actually, and it's almost it's almost funny in a way. We own in the portfolio, it's a relatively recent addition to the portfolio, Omnicom, which is an advertising company and a big advertising company. And I say it's almost funny because thanks to the arrival of the Omicron COVID variant, we all joke in our shop that we always stop and stumble when we start to talk about Omnicom because we find ourselves saying Omicron. No, Omnicom, that's the company we're talking about. So it's an advertising company, increasingly focused on digital marketing. In recent years, they reported their results last week. Very strong results, good earnings, good organic revenue growth, a very positive guidance look going out into the future. This is a company with an attractive dividend yield and a regular practice of buying back stock. And when they reported their earnings last week, the stock jumped about 10%. So, not one of your really supercharged growth, long duration equities, but a company that's a shorter duration stock, generating cash flow today, paying an attractive dividend today, paying and doing share buybacks today, good earnings, and a good reception for those earnings in the marketplace last week. In a similar way, I would point to one of the financial companies in our portfolio, also a relatively recent addition. We own Manulife, so the Canadian-based insurance and wealth management company. They also reported last week, and they also reported strong results. In particular, this is a company with a strong franchise in Asia, developed over decades. That's been a strength for them, and an increasing focus on wealth and asset management. And that was very strong for them as well. So good earnings report from them. It's a company that pays an attractive dividend, currently has a share buyback program underway. So again, if you think of this duration lens, they're generating cash today, they're paying an attractive dividend today, they're buying back stock today, and that stock also reacted very favorably last week with the release of their earnings, and the stock went up about 4 or 5% that day. So it's the kind of market environment where if you meet expectations, if you exceed expectations, if you have a favorable outlook looking into 2022, and the management team says, we see things remaining healthy and maybe getting stronger, the market rewards that, has been rewarding that pretty significantly during this earnings season. And the stocks that get punished, sometimes the stocks that get punished, they might deliver pretty good earnings, but what's been happening lately is if the outlook is below expectations, those are the stocks that really get hammered in this environment. So I think luckily we can point to some of the stocks that we own. They're generating good earnings, they're increasing their dividends, and so far they're being well received in the market upon release of their earnings. So a couple of examples.
Yeah, great, thank you. The next question, John, probably feeds a bit into the work that Epoch has done on capital-light business models. And the question is, one of the reasons the market thought inflation would be transitory is that technology and disruption was driving efficiency and competition. And these factors are still in place. So while we know rates will rise in 22 and 23, isn't there a strong chance we will be back to lower inflation once supply chains are fixed?
So I'll give you my personal view. I don't know that we have an official Epoch call on what the inflation rate is likely to be this year and next. But I would say this, I think inflation rates are going to come down as these short-term disruptions are addressed. A lot of the pressure on inflation that we're seeing right now is a result of supply chain disruption. And it is true, when the Fed was talking about this originally, they said this will get resolved pretty quickly. Well, maybe not so quickly, but nevertheless, it will get resolved. Inventory channels will be refilled, and some of these extraordinary pressures on inflation will start to ease. What does that suggest? It suggests to me that the United States, which just reported inflation of 7.5% last week. I mean, I'm old enough to have lived through the 70s and the inflationary period that we experienced then. I don't think that's what's happening now. So what I'm getting at is, I think that as these supply chain issues get resolved and inventory channels are refilled and companies sort of get back to normal wait times. So you could call up a company and say, here's what I'd like to order. Can you deliver it to me in the next 30 days under normal shipping terms? And they'll say, yes, I can take your order and I can ship normally. But I also think that there is some residual inflation that is in the system, and some of it is a result of different ways of doing business, and some of it is wage pressure. So there really is no denying that wage pressure has been significant. It's been hard for businesses to find workers. It's been necessary for many businesses to raise their wages to attract workers, and that's not going away. So my sense is, my guess would be that even as we start to see inflation numbers come down from these very high levels in coming quarters, that when all is said and done and the pandemic is over and businesses are really operating back to normal in terms of supply chain, I think we're going to be looking at inflation around the world that is maybe 2.5%, 3% or 3.5%. I think that there'll be this residual inflation that we're left with when this is all said and done. And I would hasten to add, I don't think that's a bad thing. Central banks around the world have been trying for years to get inflation of around 2%. The view has been a little bit of inflation is healthy for the global economy, and we're aiming for around 2%. And most central banks have struggled to get inflation up to around 2%. So I think what we're going to be left with is an environment with higher inflation than we had before the pandemic, but still modestly higher interest rates, and above trend economic growth. I think that's a very healthy economic backdrop for businesses. So I do think inflation is going to start to come down. I don't know if this was the peak or if the peak is next month or the month after, but at some point in 2022, we're going to start to see these inflation numbers come down, but I don't think we're going to go back to really, really low / no inflation. I think we're going to be left with some residual inflation in the system.
Okay, John, I'm conscious of time. I know it's getting late in New York. We're running up to an hour here in Australia. So I just wanted to thank you for taking the time this morning or your evening to present to our clients today. We look forward to the time when you can actually come back to Australia and meet with our clients once again in person. And hopefully we are getting closer to that happening. But John, thanks very much.
Steve, my pleasure. Always happy to have a conversation with you. Look forward to the next one, and I look forward to coming back to Australia real soon.
Great, thank you. Ladies and gentlemen, thank you for your time and ongoing support of the Epoch funds. It is very much appreciated. In closing, this income strategy has delivered 5.66% income per annum since inception, going back to 2008. And it really was designed for retiree investors as a simple and straightforward solution. Epoch's shareholder yield approach is the proverbial tortoise in the race against the hare. It might have fallen out of fashion recently, but the world is changing. And as interest rates normalise and global financial markets adapt to a new fiscal and monetary reality, we believe shareholder yield is very well positioned to succeed from here. I'd encourage you all to visit Epoch's website. That is eipny.com. They've got some fantastic insight papers, white papers, podcasts, etc. So I'd encourage you to go there. Hopefully, as I said earlier, we can come back and see you all soon in each of your capital cities. But until then, once again, thank you for your support and have a great day. See you next time. Thank you.
Cheers.